This video covers the market for reserves, in other words, the Fed funds market. First, we'll learn how the Fed manages the Fed funds rate using the discount window, reserve requirements, and open market operations. This analysis describes how the Fed used to manage the Fed funds rate pre-Great Recession. But the concepts learned here still apply to the funds market today, but just in a more limited sense, which I will unpack later in the video. Next, we will briefly discuss two interest rates the Fed created in 2008 but got rid of in 2021. The interest rate on required reserves, which means exactly what it sounds like. The Fed paid interest to commercial banks for holding reserves with the Fed. And not only that, the Fed paid interest on excess reserves, reserves in excess of what was required. Banks hold excess reserves for three reasons. One, as a form of insurance policy in case customers want future loans. Two, the Fed gave commercial banks reserves when it bought securities from them during the many quantitative easings that took place. And three, commercial banks hold reserves simply for liquidity purposes, some of which is required by liquidity requirements. Next, we'll learn about several changes the Fed made during COVID. In particular, the Fed eliminated reserve requirements in 2021. That's right, they eliminated reserve requirements in 2021. And as a result, interest on required reserves and interest on excess reserves no longer apply because it doesn't make sense. Instead, there's now just one interest rate on reserves called the IORB, Interest on Reserve Balances. Finally, with these changes in mind, I will try to describe how the Fed manages the Fed funds rate today. Here is a depiction of the reserve market in normal times, pre-Great Recession. It's a great place to start our discussion because it's relatively simple. And even though it describes how the market worked pre-Great Recession, it still applies today, but in a more limited sense, as I'll describe shortly in this video. Now, let's look at the diagram. Supply equals demand, and the equilibrium interest rate is at 0.1, at Fed funds rate 1, with reserve balances for the whole commercial banking system at R1. The demand curve shows the willingness of banks to hold reserves is negatively related to the Fed funds rate, because as the Fed funds rate increases, the opportunity cost to hold idle reserves goes up relative to lending them out at higher interest rates. When the Fed funds rate falls, the quantity of reserves increases. The quantity of reserves demanded increases. The vertical supply curve that you see in the middle is set by the Fed, and it's vertical because we assume the Fed does not change the quantity of reserves in the system based on the Fed funds rate. It just anchors and sets a reserve amount, which I'll just call R1 in this diagram. The horizontal part of the supply curve indicates the amount of borrowing at the discount window. Borrowed funds, right here. That's the amount of borrowed funds through the discount window. And here we're just assuming there's one discount rate. Normally, the length of the horizontal part of the supply curve is 0. So normally, this part right here is 0. In other words, the length is 0. Because under most circumstances, there's not much in terms of discount window action. There's very little discount window action, so the length of this line is rather small compared to the way I have it drawn here. But nevertheless, if there's a surge on the discount window, this horizontal line, this black line gets longer and longer, and it just shows you that there's an increase of reserves supplied at the discount rate that the Fed sets. So now the question becomes, what happens when the Fed changes the discount rate at the discount window? Does it have an effect on supply and demand? Will 0.1 change as a result? Well, let's look. Let me clean this up a little bit. And let's say the Fed cuts the discount rate. If it cuts the discount rate, basically what happens is this horizontal line drops down to a new discount rate, whatever the Fed sets the new discount rate at. It has no effect on the equilibrium interest rate. It's just that whatever banks show up at the discount window looking for funds, they're just going to be charged a lower rate. Now keep in mind, I'm still keeping the discount rate above the equilibrium Fed funds rate. The Fed usually keeps the discount rate above the equilibrium Fed funds rate to discourage everyday borrowing from the Fed. That's not what they want to do. They want this to be emergency lending, or at least lending when the commercial bank is in a bind. Now, let's go in the other direction. If the Fed increases the discount rate, it's going to have no effect either on the equilibrium interest rate. It's just that this whole horizontal line will shift upwards at the new discount rate that the Fed declares. So as you can see, changing the discount rate really doesn't have much of an effect on the market under normal times. It doesn't change the equilibrium rate. So now let's look at changing reserve requirements. So here again is a depiction of the Fed funds market in normal times, pre-Great Recession. Supply equals demand, and the equilibrium interest rate is at 0.1. At the Fed funds rate 1, with reserves in the banking system equal to R1. Now suppose the Fed decides to lower the reserve requirements. Banks are now required to hold less reserves, implying they now demand less. So what happens? The demand curve shifts to the left. There is now a new equilibrium along the unchanged supply curve at a lower Fed funds rate. Let's call it 0.2, with Fed funds rate 2. Now this makes sense. If demand falls, price falls. The Fed funds rate is the price of funds. And the other thing you want to remember is these things are ceteris paribus exercises. So we change one thing at a time so we can keep track of what happens. So the supply curve is unchanged. The Fed recently dropped reserve requirements from roughly 10% of deposit balances to 0%. Does this mean the demand curve disappeared or melted into the y-axis? No. There's still demand for reserves, just less. There will always be banks that need to borrow in the Fed funds market for liquidity needs and general management of funds. And don't forget, there are government-sponsored entities like Fannie Mae and Freddie Mac and the Federal Home Loan Bank Board that participate in the market by demanding overnight funds for their massive operations. So my point is, the demand curve for reserves in this analysis still exists, even without reserve requirements. And by the way, even if there are no reserve requirements at the moment, the Fed is likely to bring them back once the market settles down. Now, for the sake of completeness, let's look what happens when the Fed increases reserve requirements. Starting from the equilibrium point 1, you're going to see an increase in the demand curve, something like this. Demand curve shifts out to the right. A new equilibrium pops up for the Fed funds rate at 0.3, let's call it. And we'll label that Fed funds rate 3. So you'll see the increase in the Fed funds rate. Now let's work out what happens when the Fed conducts open market purchases or sales of securities. Let's start with the Fed selling securities to commercial banks in return for funds. This drains reserves out of the banking system so that the supply curve shifts to the left and the new equilibrium ends up at, say, 0.2. With a higher Fed funds rate, say FFR2. If the Fed purchases securities, similar to what it did with quantitative easing, the supply curve shifts to the right, say to 0.3, and the Fed funds rate drops to FFR3. Notice in both cases, I kept the discount rate constant, and I assumed that there might be a little bit of borrowed reserves by having that horizontal line at the discount rate. Now what I want to do is cover how the Fed manages the Fed funds rate post-Great Recession using the IORBR, interest on a reserve balances rate, implemented by the Fed in 2021. Notice in the graph I got rid of the horizontal part of the supply curve for borrowed funds, and I got rid of the discount rate to keep things simple and clean. Since the Great Recession, we've been in an ample reserves regime, which means that the Fed has pushed the reserve supply line so far to the right through quantitative easings that the supply curve no longer intersects the demand curve. Let me show you. A supply curve way to the right presents a problem. In effect, the Fed funds rate has been pushed to zero and is stuck there at what is called the zero lower bound because the Fed funds rate can't go below zero. And not only that, the Fed is out of bullets to spur economic growth through lower interest rates. It can't drop rates any further. Believe it or not, there is a solution to this problem, and it's relatively simple. The Fed began paying interest on reserve balances, the IORB. The rate paid on reserve balances sets a floor on the Fed funds rate, so it's no longer zero. Let me show you. So now what you see is the supply curve shift far to the right in red, and now we have the IORB, the interest on reserve balances, imposed there, that horizontal line, and that's set with an equilibrium rate too. The interest on reserve balances sets a floor to interest rates. Let me explain. Well, let's go back to first principles here. The demand curve for the Fed funds market shows the willingness of banks to hold Fed funds for a given interest rate. So when that interest rate goes up, the demand for Fed funds declines, and when the interest rate goes down, the quantity of Fed funds demanded increases. That line, that downward sloping line, represents the willingness of various institutions to pay for Fed funds. That demand curve technically extends all the way down to the x-axis to zero. It's not shown that way, but it actually extends all the way down to zero. That just means that there are some participants in the Fed funds market that are only willing to pay those low rates. Now, when the Fed imposes or starts paying interest on reserve balances, that means the Fed will pay interest on reserves parked at the central bank automatically. And if the Fed pays a high enough interest rate on reserve balances, no commercial bank will want to lend at rates below that. If the interest rate on reserve balances is set, say, at a 5% rate, why would a commercial bank want to lend at rates that are lower than 5%? This, in effect, sets a floor on the Fed funds rate, a floor that in this example is well above 0%. And how did the Fed do this? It simply decided, with congressional approval, to pay interest on reserve balances. So in this situation, what happens to the lower end of the demand curve? This area. Well, it still exists, but it's inoperative. In other words, it represents the willingness of some participants, some commercial banks, to pay really low rates to borrow funds, but those transactions will never happen because the lowest interest rate that'll happen is at the interest on reserve balances. Therefore, the demand curve looks like this. It's downward sloping all the way along here. And then when we hit this interest on reserve balances, the demand curve extends out into the right. And now it intersects at point 2 where we have an equilibrium. The equilibrium interest rate is where supply equals demand, and that's now at point 2, given that we have quantitative easing and the supply curve for reserves is way out to the right, and we now have an interest rate on reserve balances set at 5% here. So now, notice the implications for the Fed funds market. If the Fed moves the supply curve back and forth, this supply curve right here, if you move the supply curve back and forth through open market operations or quantitative easing, it's going to have no effect on the interest rate on reserve balances. We're going to stay on the flat line here. Interest rates will not change by moving the supply curve back and forth through open market operations or even additional quantitative easing. Well, that in and of itself presents a problem. So how does the Fed actually get out of this bind? Okay, it has, keep in mind, It has quantitative easing, a huge balance sheet, so the supply curve was way off to the right. It got rid of the floor of zero for the Fed funds rate by imposing an interest rate on reserve balances, which is this line that goes through point 2. Now, how does it get out of this and actually implement monetary policy? Well, it's not that hard. Let me show you. In effect, what the Fed can do now is it can just declare a new higher interest rate on reserve balances. Call interest rate on reserve balances 2. And now it's going to drive the interest rate up. And now we're going to be on this flat spot. And the demand curve will be downward sloping here at high Fed funds rate. And it'll be flat around 0.1 approximately, or where this interest on reserve balances is, right here. Right on the flat spot, the orange flat spot. And so there you have it. The Fed can raise interest rates quite easily, or even lower interest rates, just by changing the interest rate on reserve balances. And how does it change the interest rate on reserve balances? Well, the Federal Open Market Committee just declares it at the end of a meeting and says, look, we're going to set the interest rate at, say, 6%. And then this is right here. This would be 6%. To summarize what we just learned, I have this slide where I have a dividing line at this black spot right here next to R1. See this dividing line? It's basically where this kink is in the demand curve for reserves. And what I'm saying is, if the supply curve is off to the left of this kink, then changes in the discount rate, changes in reserve requirements, and changes in open market operations will work. They'll change the placement of the supply and demand curves. Conducting open market operations will shift the vertical part of the supply curve and will cause the equilibrium rate to change. Changing the discount rate will cause the horizontal part of the supply curve to shift, and that probably won't affect the equilibrium rate. And then changing reserve requirements will shift the demand curve and the equilibrium rate, just as I explained a minute ago. However, when we're in an ample reserve regime and the supply curve for reserves has been pushed way out to the right and we are effectively on this flat spot of the demand curve, the only thing that's going to cause the Fed funds rate to change, the Fed is going to have to change the interest rate on reserve balances. And when it does that, this black line, this black horizontal line will either go up or down, and it'll set the new equilibrium Fed funds rate. So that's why I was saying at the beginning of this video that the old market, which is kind of represented here, still applies in this analysis. And this is where we'll eventually end up in the future. But for the moment, we're in this world where we're in an ample reserve regime. And the only way interest rates are going to change is by the Federal Open Market Committee changing them at its meetings. And that's exactly what it did after COVID and inflation struck us. So starting in 2022, the Fed has increased the Fed funds rate, the target Fed funds rate. In other words, the interest rate on reserve balances, 11 times by having the Federal Open Market Committee simply declaring a new rate at nearly every Fed meeting since 2022.